Thank you for joining us. Welcome to Business Incorporated, coming to you live from our Lagos studios. I'm Chimeze Obi Iwago. On the show today, IMF tells Senegal to keep some of the $2.2 billion bond for 2019. Mozambique bond creditors hope to start constructive debt restructuring talk. Plus, African leaders agree to form a $3 trillion trade bloc. Let's get the show started now with the markets. And starting off here on the African continent, South Africa's equity market was down at intraday as traders were cautious ahead of a credit rating review by international agency Moody's scheduled for Friday. The JSE index was down 1.03%. Egypt was also down 0.33%, but the market here in Nigeria backed the trend, trading up 0.07%. Kenya was up 0.98% on Wednesday. And in the Middle East, most stock markets were soft at intraday as several companies in Dubai and Qatar went ex-dividend, while Saudi Arabia continued to climb on optimism over its entry into emerging market indices. The Saudi index rose 1%, anticipating FTSE's decision at the end of March on whether to upgrade Riyadh to secondary emerging market status. The Abu Dhabi index edged up 0.24%, but Abu Dhabi Commercial Bank was down 5.2% as it went ex-dividend. Air Arabia was down 8.5% in Dubai as it too went ex-dividend, pulling the index 1.78% lower. Qatar's index was down 0.54%. Big movers, United Development, which fell 6.8%, and Commercial Bank, which lost 3.4%, both went ex-dividend. And in Europe, stocks traded lower in early trade as traders reacted to a rate hike from the U.S. Federal Reserve. Let's bring in Janelle now to talk to us. Hello, Janelle. Good afternoon. Oh, we seem to have lost Janelle there. In the U.S., stock index futures ticked lower ahead of Thursday's open as investors digested the U.S. Federal Reserve's latest monetary policy decision. Around 5:55 a.m. Eastern Time, Dow futures slipped 176 points, indicating a drop of 141.31 points at the open. The Nasdaq and the S&P 500 futures also indicated a negative open for their respective markets. The moves in pre-market trade come after Wall Street finished Wednesday's session in the red, as widely expected by the markets. The Fed raised interest rates by 25 basis points on Wednesday and upgraded its economic outlook, saying that economic activity and jobs gains had been strong in recent months. Central banking news will remain on the agenda as the Bank of England holds its latest monetary policy meeting. A slew of economic data are also due to come out, with jobless claims at 8:30 a.m. Eastern Time, followed by the FHFA House Price Index at 9 a.m. Eastern Time. At 9:45 a.m. Eastern Time, a U.S. Flash Composite Purchasing Managers Index is due out, followed by the Kansas City Fed Manufacturing Survey set to come out at 11 a.m. Eastern Time. And in Asia, markets closed mixed today in what proved to be a choppy session after the U.S. Federal Reserve raised interest rates for the first time this year. Japan's Nikkei 225 rose 0.99%. Elsewhere, South Korea's benchmark Kospi advanced 0.44% to close at 2,496.02, a 7-week low. Greater China markets gave up early gains, with the Hang Seng Index easing 0.61%. Over on the mainland, the Shanghai Composite lost 0.52% to close at 3,263.83, and the Shenzhen Composite edged lower by 0.49% to end at 1,849 points. In Australia, the S&P ASX 200 slipped 0.22% in choppy trade. Meanwhile, the Hong Kong dollar slid to a fresh 33-year low during the session. And back to Europe, where market traded lower in early trade as traders reacted to a rate hike from the U.S. Federal. Reserve. Let's bring in now Janelle Dumalon to talk to us. Hello, Janelle.
Hi, good afternoon from Frankfurt.
Right. We have seen the decision taken by the Federal Reserve announcing the first rate hike for the year. And of course, the Bank of England is about now announcing its own rate hike. What is likely going to be the trend that Governor McConnell will take?
Well, it's widely expected that policy will be left untouched at this meeting. The Monetary Policy Committee is expected to vote 9-0 to keep the benchmark rate at 0.5%, so where it is now. Rather, what investors will be watching out for will be clues as to whether there will be a rate hike 2 months from now in May. And February, Carney did say something about tightening policy earlier, and to a greater extent, that kind of left markets surprised. What markets expected before that, of course, was about 2.5 hikes over 3 years. There are a few factors that already do support the case for tightening sooner or later, like, for example, the fact that a transitional Brexit agreement is now in place that provides some certainty for the economy, as well as the future trading relationship as it's still being defined. So that's certainly helpful for the central bank's policymakers if they want to go on this tightening path. But as we know, there are caveats to absolutely everything. So not everyone is really convinced that further tightening is the way to go. There's been a slight rise, for example, in the unemployment rate and a recent slowing in inflation. But it's generally assumed that Mark Carney is unlikely to veer off the path of more tightening.
All right, the U.S. President Donald Trump is set to hit China with a new $50 billion set of trade restraints and tariffs. How of this global trade fight do analysts think President Trump could afford to juggle at the same time?
It really depends on how the parties respond and how big of a trade conflagration this actually ends up being. Now, for China's part, they would definitely read a signing of the tariffs as a declaration of a trade war. They've spent a lot of time in the run-up today trying to strike a conciliatory tone towards finding a win-win situation. And they've said that they'd open up their financial markets more, they'd try to and better protect intellectual property, and halt the forced technology transfers. And those, of course, have been key complaints that the U.S. government has been on about. So but they're also coming up with more combative measures, let's say, if they do, if tariffs are signed into being today. So they're apparently preparing retaliatory measures that would hit mostly the agricultural sector in the U.S. And we know that this is one of the sectors that's still running a trade surplus. We've heard from the foreign ministry, they've said they don't want to fight a trade war with anyone, but if anyone forces them to fight one, they'll neither be scared nor hide. Now, for the EU's part, they said that they've been fairly confident that they will be included in a list of exemptions. The problem, of course, with all of this, of course, is that the final word will still go to Donald Trump, and it's anyone's guess where this is going to go. So broadly speaking, European indices have been down this morning in order to, and that just reflects the sentiment of how worried investors are that a trade war, whether between the EU and the U.S. or elsewhere, that will affect them anyway, whether that will happen.
All right. Thank you very much for your time, Janelle. Enjoy the rest of the day.